Hi everyone, Joe Gentili from Left Tail Risk Advisors. So in this video, I want to go through life insurance policy illustrations. So this is a very important topic to understand if you're considering purchasing a life insurance policy or you're in the process of doing that now. So the way the National Association of Insurance Commissioners defines a life insurance illustration is they say an illustration is a presentation or depiction provided to prospective or new policy owners that shows how the policy should perform under specific circumstances set out in the illustration. Okay, so basically what that means is that the illustration is supposed to show you how a life insurance policy functions. It's a model to show you if you input these certain assumptions, this is what comes out. So you understand the relationship between premium and cash value and death benefit. You understand what's guaranteed and what's not guaranteed. So what happens is because this is a numerical presentation, a lot of times there's a sleight of hand that agents do and is encouraged or winked at by carriers, where instead of using the illustration as a model to show you how the policy should function, they use it as a projection. And if they have overly aggressively numbers illustrated, that's a sales tool that they use to project really good policy performance, make something look like a really good deal when it's not. They're just simply plugging in higher numbers. That is something very to be very cautious about looking out for, because for certain policy types, that could lead to disappointment, where over time the cash value is not accumulating the way you'd hoped, the death benefit's not growing the way you hoped. In other types of policies, it could be catastrophic and could lead to lapsed policies. So if we're looking at illustrations on the whole life insurance side of the spectrum, that tends to be a little less risky, especially now. So the way the numbers are inputted for a whole life insurance illustration is the policy's performance, its crediting is it's illustrated using the current dividend rate of the life insurance carriers. So the dividend rates right now are historically modest. So they are not guaranteed to happen. They could, in the future, they could be lower, they could be higher. Nobody really knows or can predict what's going to happen with that. But what we do know is on a historical basis, this this is probably using today's dividend rates is probably would be considered conservative. May not happen, but based off of history, it's certainly within the realm of possibility that you're going to get crediting at dividend rates in the future similar to or better to what they are today. And whole life insurance with dividend paying mutuals, there's for most of these companies is a very long track record. For the larger ones is over 100 years of dividend paying history. So there's a lot of time to look at that. That said, you want to understand that the dividend rates are not guaranteed. That is a non-guaranteed part of the policy, and the policy dividend rates can be higher or lower. What's nice about whole life insurance and one of its main features is that the premium is guaranteed. So as long as you pay the premium, the policy stays in force. So if the dividend turns out to be lower than it's supposed to be, it's not going to cause a policy lapse. Now, this can get a little tricky depending on how you're buying the policy and how you're using it. So, for instance, if you're introducing premium financing into the equation, anytime you're introducing borrowing and leverage, obviously that could increase the risk. Or if you're planning to borrow out of the policy a lot, if you're getting it in order to take loans out, then that could obviously um, have some lapse risk involved with that, if that's how you intend to use the policy. But for most people, that's not the case. Then we go to the universal life side of the spectrum, indexed universal life in particular. This is an area where right now I'm seeing a lot of abuses, frankly, in the way these policies are illustrated. They are illustrated in a very aggressive manner. There's been some rules put on this that have tried to rein this in, and it's been somewhat successful, but not completely successful. We're still seeing policies illustrate crediting rates that are aggressive. We're seeing bonus rates get illustrated in these policies that are aggressive. We're seeing maybe loan scenarios that are not realistic long term, like they're showing loans occurring at a wash where the interest rate on the loan and the crediting rate cancel each other out. That's not guaranteed. So there's a lot here in order to give the impression and to encourage selling these policies on the illustrations as projections rather than as a model as to how the policy works. And what this leads to is it leads to people buying the policies that that look best on paper and have the best projections. And this carries a lot of risk because if you're funding the policy, if you're paying premium, using these policy assumptions, assuming a 6% rate of return on the policy, let's say, and the policy returns less, then because this is a universal life policy, you, the policy owner, you bear the risk. The premium is not guaranteed, so you bear the risk that you underfunded this policy. So there's kind of there's a cruel reality to this in that the better the policy illustrates, the higher those projections are. That means that the lower the policy can be funded to keep it in force because the crediting rate is carrying so much of the weight. But if that turns out to not be accurate, and I would bet money that in a lot of these insurance policies it will not be accurate, then the amount of premium that people are paying is going to be too little to keep that policy in force for life if they live to normal life expectancy. And that leads to a disastrous consequence of having a lapse late in life when either the person can't afford to put more money into the policy to keep it in force because it's behind by so much and the cost of insurance is so high at that point, or they can't afford to get it, or they can't get a new policy because their health has changed and they're older at that point. So the consequences for folks to treat an index universal life insurance illustration like a projection can be very severe. So be very careful of that. Even if you're aware of that, if you're aware that these are not projections, the other piece you need to be aware of, especially with the indexes that are created by the insurance companies, is they'll show you results of how the index performed looking back over a long period of time. And almost always they're showing these indexes performing very well. That's not a projection going forward, but they're trying to say that, look how well this has performed in the back. So on the back end, so these illustrations that we have now, they're actually conservative because this index just shoots the lights out. What is either in the fine print or they're not saying at all is that index didn't exist for the amount of time that they're showing you results for. It's completely hypothetical. And those indexes are created a lot of times as a sales tool where they're created to look good going backwards, but not necessarily to perform well going forward. And that's borne out. A lot of these indexes, once they've gone live, their performance as a live index has been underwhelming. So it's just another thing to watch out for. Because you, the policy owner, bear the risk of the premium not being sufficient that you're paying, it's especially important if you have an index universal life insurance policy to have a policy review done every year to make sure that the premium that you're paying is sufficient to keep the policy in force. And if you haven't done that in a while, it's worth it to do it because catching a problem early with one of these types of policies, you can fix it. You could fund it to bring it up to health. If you catch that later in the process, it could be too late. So very important if you're in the process of buying a life insurance policy that you understand what a life insurance illustration is meant to do. It's meant to show you how a policy works. It's meant to be a model. And what it's not meant to be, it is not meant to be in any way a projection or a guarantee of policy performance unless you're dealing with the guaranteed portion. And there's a lot of danger in having this misunderstanding. And there are agents that will encourage this misunderstanding, and there are carriers that will also encourage this. So you have to be very cautious with this because the consequences of misunderstanding this point can be very severe, especially later on. It can lead to a policy lapse. So if you have any questions, please feel free to reach out. I'm always happy to help and answer some questions. And if you like this video, I really encourage you to like and subscribe for future ones. Thank you. Bye.